Good evening, everyone. Welcome to Mutual Fund Pe Charsa by Paytm Money. And today's topic is how to select the right mutual fund. And guest today with us is Mr. Gurpreet Singh Saluja, and he's a certified MFI member and managing director of Gurpreet Saluja Financial Service. He has more than 8 years of experience in portfolio management and currently leading the firm. He is a financial investment professional, value investor, blogger, and has got deep interest in financial education. So, welcome, Gurpreet.
Thank you, Neeraj and Team Paytm Money for inviting me today. Thank you very much.
It's a great to have you. It's a great pleasure to have you here today. And
Yeah,
before I start, let me give you a quick disclaimer of this program.
yeah.
Investment in securities market are subject to market risk, so read all the related documents carefully before investing. Representations are not indicative of future results, so all the discussions are purely educational in nature and are in no way an advice and recommendation or recommendations. Now, having said that, in fact, today we're going to talk about how to select the right mutual fund. That is the topic.
Mm.
And if you are somebody who is new to the mutual fund investing world and wondering which fund to select, which AMC to select, which is going to serve your goal. And today, Mr. Gurpreet is there to help us. So, Gurpreet, before I start, very quickly, your view on, because ultimately mutual fund investing is a function of our market economy and everything. So before I start, a quick question to you. How do you
Mhm.
think the market is? How do you think the economy is heading towards? What's your view, Gurpreet?
I personally feel the Indian economy is very positive in coming 5 or 7, 10 years down the line. Basically, what's happening globally is maybe causing a concern for the investors, retail investors. But in India, those who are investing in Indian markets, I personally feel that they are not going to get disappointed in coming 5 or 10 years down the line because the way RBI has taken the calls and control the inflation as well as the economy is boosting, so we can see that how the markets are performing in recent times when the overall the global economy is not able to perform that well. If you see the US markets, or if you see the technology stocks from the last 1 year, due to this global issues as well as the inflation issue. But Indian markets have done very well so far, and I personally feel that time that we are going to see in the Indian markets in the coming 10 years, that nobody as an investor has seen so far. Some might boast around that they have seen the time of 2003 to 2007 period. I feel that coming 10 years are going to give you the far better the returns that earlier it has been. Obviously, there are some things that we cannot be sure of, but I personally feel I'm very positive when it comes to the Indian equities, and I'm totally 100% invested into equities. And I personally feel that markets are going to deliver the returns that investor has not expected so far, and nobody need to worry about what is happening globally. If you are disciplined and like say faithful investor of equities, you Indian equities specifically, then you are not going to get disappointed and you will get the better returns in coming years.
Wow, that's a very, very optimistic and very, very positive words about Indian market and about Indian economy, right? So obviously, one of the way to get invested, remain invested in Indian market is through mutual fund.
Mhm.
Now, when you talk about mutual fund, Gurpreet, it's not that straight away go ahead and ask or started choosing which is the good one, which is the best one. There is
Mhm.
definitely a process, right? It's a first you have to probably decide what's your goal. You have to do your risk profiling, etc., etc. So, if somebody have to start investing, somebody who is absolutely new to mutual fund investing,
Mhm.
what are the processes do you think? What are the first things, step one, step two, step three? If you can just give us idea about that, the whole process of
Definitely.
investment.
Definitely. So whenever I'm talking to many of the investors these days, and I have seen that the new investors, those who come into and those who have heard about mutual funds and are willing to invest in the mutual funds, many investors, I'm sure you might also have encountered such type of investors, that they don't know about that there are many categories of mutual funds. 90% people think that there are only equity mutual funds. So for them, I would like to firstly clarify that there are different set of categories available in the mutual funds. First, it's equity, which where the fund manager invests our money into the equity markets, like stock market, which we call. And other is the debt funds, in which the fund manager invests invest in the government securities, money market securities, as well as different bonds that are fixed income products that are available in the market, where the fund manager lends our money to the further issuer, and they earn a fixed interest on that particular amount. So there are two certain type of categories. And if you talk about other two, are one is gold category, and also there is available some real estate funds, which are not that much popular as of now. But if we talk about core, there is one equity category and other is debt. So whenever one has to start its mutual fund journey, so I personally feel that you have to go through it, what is actually your risk profile. Many feel that markets are performing, they are actually and then they come to the investing into equity markets, like say through mutual fund they are going and searching about the best performing funds in the internet or their applications, and then seeing that how the recent highest performing funds, they are investing their money in that funds. But they are not doing a due diligence, which is the right process, I would tell you, is that you have to firstly ascertain that what is your risk profile. Now when it comes to risk profile, one has to ascertain that what are their financial goals. Before moving to risk profile, one has to ascertain what are their financial goals that they want to achieve through this investing or their money. Like say someone who is recently married and got some young children, and he wants to plan their education, higher education, as well as the marriage of the children. So say someone who is having a 5-year-old daughter, he wants to plan his her education in coming, like say 13 or 14 years down the line. So he, and for education, if he is planning that today's cost is 50 lakh rupees, so as per the inflation, like say 8%, if you calculate 13 14 years down the line, the cost will be around 1.10 1.2 crore rupees. So one has to see that how much I need the money in coming 13 or 15 years down the line, basic on their basis on their financial goals that they want to achieve. Once someone has ascertained that, then they have to check that in which investment product they can invest, and so that they can create that sort of wealth. So if someone is saying that I can if I need 15 in 15 years, if I need 1 crore rupees, I can only invest 20 or 25,000 rupees per month. Like say if he want to go through like say recurring deposit RD investments, or some secured investments, or even some wants to go through debt mutual funds, like which are safe, and we don't want to take that much of risk. So in if we take a on an average 6 or 7% return from the fixed income products available in the market, then that is not possible to achieve 1 crore in 15 years through with the investment of only 25,000. For that someone needs a 45,000 rupees. So when some gets that I have to invest 25, I can only invest 25,000, I cannot invest 45,000, then there it comes the need, that am I willing to take is there a need to take the risk? Then the answer is yes. Here you have only 25,000 rupees per month, the surplus, which you can invest for your daughter's marriage in for next 15 years to achieve the target of 1 crore. And for that you have to take equity risk. Why? Because 6 or 7% rate of interest will not help you achieve the goals in coming 15 years. So if one first part that we in among risk profiling, the three questions that we need to ask is there a need to take risk? The answer is yes here. Why? Because I need 45,000, I can invest only 25,000. So there is a need to invest in equities to take that sort of risk. Then there is there ability to take risk? Can I take the risk? Like obviously, because if you can invest 25,000 rupees per month and for 15 years, I am assuming that your income is around 1 lakh rupees, so that's why you are starting with 25,000 rupees per month. So in that case, that your ability is, if you are willing to invest 25,000, then there is ability, your ability is there to take the equity risk. Then third question is, am I willing to take that risk? So in that case, first we need to understand that in equities, our invested amount can go 10 or 20 or 50% down during the worst scenarios. Like say in the period of COVID, we have seen the investments fall around 40-45% of the portfolio. So if you need to understand that your invested amount can go down to 20-25% from your invested capital. So if you are willing to take that risk, then only you should go into the equity funds. Not just because your friend is investing, or you saw some people created money in last 2 years, so you are investing into equity mutual funds. So this is the process that you need to follow. These are the three steps where you need to ascertain that whether you should invest into equity or not. Then this is the first process that I feel that you have to analyze your financial goals and your requirements, then your risk profile. Now if you are willing to take risk, your need is there to take the equity risk, your ability is there to take the equity risk, then you have to select which funds I have to go. Right? So this is the process where you which you need to follow, which I'll be discussing further also. Like say I till any question till now, Mr. Neeraj?
No, no, go ahead, go ahead.
Yeah.
In fact, I would like to request our listeners also that if you have got any
Mhm.
questions in mind, please feel free to type it in the chat box, and we'll be posing the same questions to Gurpreet.
Right. So
Yeah,
basically,
and yeah, go
Mhm.
ahead, Gurpreet.
So basically, this is a process. First, financial goals, ascertaining of financial goals is very important. Like, don't ever invest in a mutual fund just because your friend is investing, or your some other relative is investing, and you are seeing that it is mandate. It is good to invest in equity mutual funds when you have to boast around with your circle, but you have to ascertain where you have to go. Financial goal is the first step. Then your risk profiling is the second step. Once you have ascertained the risk profiling, based on your risk profile, you have to decide your asset allocation, like how much you should invest into equities or you should invest into debt. Then based on that asset allocation, we go to the fund selection process. So this is the four step process that you have to follow before investing into mutual funds.
Wonderful, wonderful. I think you have very, very clearly explained the four-step process, which leads to selecting the right mutual fund.
Right.
Okay. Now, coming into categories, of late, the SEBI have, redefined the categories of mutual fund. So,
Right.
what can you just sum up for the listeners to
Yes,
understand?
definitely, definitely. So among equity, basically, there is a few categories that the SEBI has categorized, came up with that categorize recategorization of the mutual fund schemes in 2017. Because previously, what the AMCs were doing, there were many schemes in the same category. Like say, if AMC is having two or three multiple schemes in a mid cap category, two or three schemes in a large cap category, so there were lots of choice overload for the investors. Investors was not able to determine which fund they should invest under which category. Like say, if a single AMC is having two three schemes in a mid cap category, and an investor wants to invest into mid cap category, which scheme he should choose? Investor normally gets confused because of the choice overload. So that's why what SEBI has done, SEBI has came up with a recategorization, where SEBI has said to all the AMCs that you have to only have single scheme in the particular category. So like say, if a AMC is having like in the mid cap category, AMC one AMC can have only one scheme only, or in that particular category. So what are the categories that they have defined in equity? We can see that there is a large cap category, where the fund manager can invest around 80 to 85% into the equities as well as the large cap companies. And then it comes the mid cap category. The other 15-20% that fund manager have the freedom to invest wherever he wants to. And in the mid cap category, there is 65% allocation should be into the mid cap stocks. And then third, there is a small cap category, where the 65 allocation should be minimum into the small cap company. And after that, there are multi cap category. Multi cap category, what the SEBI has recently announced, that 25% each into the large, mid and small cap, and the rest 20% that is left, that fund manager is free to allocate wherever he wants. And then there is also a category called flexi cap. In flexi cap, the total call is with the fund manager wherever he wants to invest, whether he wants to invest into large cap, mid cap, or totally into the small cap. That is his call. But condition is that you should 80% money should be into equities at least. So these are the main categories which SEBI has defined. Now, when it among the large, was also confusion for large cap companies, mid cap companies, and small cap company. So SEBI also advised on that the top 100 companies as per the market capitalization are the large cap companies, and then 101 to 250 are the mid cap companies, and beyond 250 companies are the small cap company. So this has cleared a lot of picture to all the investors as well as the stakeholders involved in this industry, that how the industry is going forward, how investors should allocate their money. So if you are going for a large cap fund, then you can see that okay, that there are top 100 companies in which my major money will be invested. And if you are going for mid cap companies, so that's how the allocation can happen. Now, based on your risk profile that we discussed earlier, you can see that in where you want to allocate your money more into which category. So these I've talked about equity. Similarly, there are few categorization into debt as well. So if anybody wants to, like, there are like say, in debt I can reconcile four five categories. First, there is overnight funds. Like say, if someone wants to invest for 1 or 2 days, then he can consider for overnight funds. But overnight fund does that majorly the corporates invest their money in the overnight funds. How? Because wherever in this case, the issuer borrows the money for one single day only, like say one overnight. So for 24 hours, the issuer borrows the money, and the investors who have invested in this fund, the fund manager particularly lends the money or buys the debentures for one overnight day. So these are the overnight funds. Then liquid funds. then low duration and short duration funds, and long duration funds, then government security funds. So this is the category that SEBI has defined in the debt category as well. So this sums up and gives a clear idea that how wherever based on the asset allocation as well as the risk profile, we can go ahead and choose the appropriate category for us for investing in mutual funds and achieving our financial goals.
Okay, great. So you have given a very comprehensive explanation about all different kind of mutual funds. Now again, somebody willing to invest. Now you said that next 10 years going to be really, really wonderful for Indian economy, Indian market. So if
Mhm.
somebody is willing to invest for say next 5 to 10 years perspective, so
Mhm.
what kind of funds do you basically suggest? Is it large, mid, small, flexi, or multi? Uh, what kind of funds do you basically suggest?
If here I feel like say if someone who has the good risk appetite, like he can take the
Mhm.
high risk, he is willing to take the risk, and he understand the equity market as well. So I personally feel if I myself is more into mid caps. So if I have a money which I don't need in next 5 or 10 years, I would prefer more my money into the mid cap space as of now. So depending
Mhm.
upon my financial goals, if there is some needs in that I need to fulfill in coming 3 to 5 years, then I will allocate more into large caps. But my if my money is for more than 5 years or 10 years down the line, then I will allocate more into mid caps. So this is
Mid.
how the category I can prefer as of now. And I
Mhm.
would suggest the investors who are willing to take that type of risk and understand the equity, then they can allocate more of their money into large and mid caps in coming 5 or 10 years down the line.
Okay, great. So, okay, and why not small cap?
Small cap basically there is a like if someone is new, if we are talking here,
Mhm.
then I would not suggest to directly jump into the small caps right now,
Mhm.
because the cycle for small caps takes around 4 to 5 years to give you the returns that an investor expects. So downfall is also very high. So for the new investor, I would not suggest to go into small caps straight away. So firstly, they should have quite experience, like say 2 or 3 years. They should understand how equity is performing, how the markets go, as cycle works, and then they can start slowly and steadily they can allocate increase their allocation into the small caps. In long term they can prefer small caps, there is no issue, but they have to go into the steadily manner,
Mhm.
stagnant manner,
So,
right?
so you mean to say, for investing in a small cap, there's a
Mhm.
element of timing is also important, right? You
Right,
have to
exactly.
timing it because there's a
Right,
cycle which involved around 4 years or
right,
5 years,
right,
right?
right, right.
Can you something? Can you tell us something about sectorial funds and thematic funds? There are
Yeah.
some other categories as well.
Mhm.
Can you throw some lights into those?
Yeah, sure. So in equity, there are some thematic and sectoral funds as well. So there
Uh-huh.
are like say if you want to invest into banking stocks only, so there is a banking and financial services category. If you want to invest into IT stocks only, so there is a information technology category. And if you want to go into like say healthcare, there's a healthcare category and so on. There are different sectoral or theme based categories that are available in the market. So there are sometimes what happens that there is a cycle for every category. So if we talk about like say 2 years back when the COVID hit, all the sectors were not performing, but if you see there was a huge jump in the IT as well as the healthcare sector. So the
Hmm.
investors who were active in the market, who knew how the sectors are going to perform, or obviously it was a to like those who are active, those who understand the equities, they know that IT and pharma was the hit in the coming 2 3 down the line. What we have seen in from 2020 period to 2022, and in the last 1 year we have seen the IT is not performing. The major reasons are due to the international as well as the currency depreciation that we have seen. So that's why we are seeing that equity IT is not performing from the last 1 year. But if you see 3 year, 5 year performance, it has given the fantabulous return. And in coming year 5 or 7 years down the line, I feel that IT is going to give the best returns in coming period. If you talk about the sectoral calls.
Okay, so when we invest in sectors, there is
Mhm.
an element of sector rotation also, right?
Right,
Which
right.
sector is going to play out next, and
Mhm.
one need to be very correct about that particular
Exactly.
sector.
So
Great.
this is something one the investors who have already good experience, like it has been 4 or 5 years in investing into mutual funds, and now they are looking up for they understand how equity is performing. Again, I will say that those who have those who get the equity experience, because majority investors don't have that equity experience. Majority investors pushed into the equity market I have seen recently is that after the 2020 recovery. like when the markets already recovered majorly, then they have started investing into equities. So they have not seen the that downfall that investors who invested in 2019 have seen during COVID. So one first hand experience into the equities downfall is very important. Those who have seen that downfall, they can understand, they can stay patient. So and then slowly and gradually they can increase their allocation to the sectorals.
Correct. Correct. In fact, we started receiving questions from our listeners as well.
Mhm.
The first question is from Shashwat. Okay,
Okay.
I'm just going to read it out.
Right.
What about investing in companies which invest for us, looking at equity and debt according to the market?
What about investing in a company which invests for us, looking at
Looking at
equity?
equity and debt according to market. So, can you
Uh,
make? Uh,
here I what I can understand from the question, I guess Shashwat is talking about like dynamic asset allocation funds, if I'm not wrong.
yes, I think so.
Right. So in the case of dynamic asset allocation funds, I personally feel those who are moderately conservative, those who don't want to take that much risk, I would say, then they want to invest for like say 5 or 10 years down the line, but they are not happy with fixed deposit returns and they want to take risk adjusted returns. Then dynamic asset allocation is a good to go category, and one can invest in them and remain like say we don't need to think about how the market is going to perform, because whenever markets are overvalued, those fund managers will decrease the allocation into the equities, and whenever the markets are undervalued and it is a good to buy or increase the allocation, they will automatically increase that. So one can obviously leave upon the experts who knows better than us. So this is a good to get good category to go if you have a surplus for 5 or 10 years at least, and you don't want to take that much of equity risk, and you are not even happy with the fixed deposit returns.
You spoke about dynamic asset allocation fund. In fact,
Mhm.
um, can you elaborate more? What exactly is the nature of the fund? What they do? How they dynamically keep on allocating assets between equity
Definitely.
and debt? Can you just
Definitely.
yeah?
Yeah. Before moving that, I would here like to touch upon the topic called asset allocation, which is more important and which will help the listeners to understand how this works. And basically, as I talked about earlier, that whenever you do your risk profiling, you want to invest your money, you decide that okay, I'm okay to good to go into equities. I will invest 60% into equities or 40% into debt, or like say I would invest 70% into and 30% into debt. So this is the asset allocation that you have to decide based on your time period as well as your financial goals or your requirements. And once you have decided the allocation, most of the investors are not able to rebalance properly. Like they are not
Mhm.
able to because in asset allocation, whatever asset allocation you set while investing, you have to regularly monitor it, and on a different interval, maybe it could be half yearly or maybe it could be yearly, you have to rebalance that portfolio. Like say if you decided 60% equity today and 40% debt today, after 1 year, the as per the market returns or market fluctuation, your allocation would not be remain same. Like say if the
Exactly.
markets have increased 10%, your equity will go to 66, and obviously that will also give you return, so your allocation would be around 65, 66, something, right? So you
Mhm.
have to reallocate to back to 60 to 40 again. And similarly, if the markets go 20% down, you have to allocate more into equity, like you have to again rebalance and come back to 60/40 ratio. So normally investors are not able to do that, or
Mhm.
they are not they don't have time, or they don't get to understand whether they should shift or not, or they are don't want to pay exit loads or the taxes to the government. So this is a thing that many questions goes around and they are not able to timely execute that. So asset allocation has the key element, which is rebalancing. You have to execute without falling into any emotions or anything. So if you feel that you can't do that, this is a problem that there's among the investors. So for every problem, the manufacturers, where we call the AMC asset mutual fund companies, have provided the solution, right? So for that solution, the mutual fund companies launched this dynamic asset allocation funds. So now what dynamic asset allocation does is that, like say everybody cannot go into 60% equity, 40% debt. So if someone wants to go into go like that, there is also a solution which we have heard about in the name of hybrid funds. There is a category
Mhm.
called of hybrid funds, right? So I would also again touch upon that here. So firstly, we understand equity funds and debt funds. In equity funds, there is 100% allocation will be in equity. In debt funds, the 100% allocation will be into debt. Like say someone wants to remain 60/40 forever, So yeah, 65, 70, 35. Then do you have hybrid funds? Among hybrid also there are different natures. Like say if you are aggressive, you want 65 equity, then you are aggressive hybrid. If you want 65 debt, then you can go for conservative hybrid. But if you say I don't want to fix the allocation, I want
Mhm.
like whenever there is an opportunity in the market, I want to grab that opportunity, increase my allocation to 100% equity as well. If there is a opportunity in the market, like say in 2019, I invested some amount, and I saw that there is a correction in the market, steep correction in the market in March 2022. So that was an opportunity. If we see this year also, we saw the opportunity in January, February when the this war thing happened and the market started crashing. Right. So that was also opportunity to increase the allocation into equities. So if you feel there is an opportunity, if you see and you are not capable enough to do everything all by yourself, then the fund manager will do this. Now, what the
Mhm.
dynamic asset allocation fund will do, whenever there is a fall into the equity market or the equity valuations, he will increase the allocation into equities. He can go up to 100% as well. And if there is a overvaluation, like markets are rising high enormously, there is no logic to rise that much high, which we have seen in 2007 period, but not recently. We have not seen that. But I feel if there's a euphoria comes in ever in the future, then there could be a possible scene that a fund manager can go into 100% debt, 0% equity. So fund manager will automatically change that allocation. So an investor don't need to worry about the allocation. He don't need to timely book the profits because the fund manager in itself will do that. So this helps the investor into there will obviously when there is a asset allocation change, there will no exit loads applicable. There is no short term or long term taxes applicable. So this provides you the investor the extra advantage to get the best returns, risk adjusted returns, which we call from this particular category.
That's pretty interesting actually. This fund is a self-balancing kind of a fund, which market goes up, then more allocation into debt, and market comes down, and more allocation to equity. It's okay.
Right.
Now, again, depending on his priorities, goals, and risk profiling and everything, one is going to go for large cap, mid cap, small cap, or now, what are the things before choosing a particular fund, AMC, right?
Mhm.
Particular fund.
Mhm.
What are the
Mhm.
things that we need to
Mhm.
take into consideration? Now, if I prioritize, सबसे ज़्यादा weightage किसको देना चाहिए कि selecting a fund, and उसका बाद accordingly, what
Mhm.
are the other factors?
Among AMCs you're talking?
Amongst while selecting a fund, अगर मुझे कोई fund select करना है, तो what are the key
Uh-huh.
factors that I will take into consideration?
Okay, okay. So firstly, I personally prefer कि उसका like I personally whenever there's a selection of funds, like say I have decided the asset allocation I am going to into equities for
Hmm,
example, ठीक
hmm,
है, and then I have decided okay I'll go into 50% 60% into mid caps and 20% into large and 20% into small for example, right? So if I have decided my further categorization as well, then when it comes to fund selection, what I'll see, okay, what are the consistent performing funds in the last 1 year, 3 year, 5 year periods.
right.
Okay,
Hmm,
so consistency is the first key. My fund should have beaten the benchmark consistently from the last 5 years. And based on that, I would prefer the top, those who have a decent AUM growth as well. Like there are funds who have the AUM of 300 crores from last 5 years. There are funds who might be having an assets of like say 3,000 or 30,000 crores from last 5 years. So I will see the median growth of the assets as well. So and the fund manager was capable to beat the markets as well as provide the alpha in the last 1 year, 3 year, 5 year period. If the fund has consistently given me these type of these on these parameters is doing well, there are few risk measures that we go through as well. Like say you can go through standard deviation, which means which helps you to understand the fund is not that much deviating from the mean, right? And mean is should be positive than the category average, right? And these are the one or two parameters which you need to see. And third is alpha, that you need to see the fund is going delivering positive alpha compared to its category. Based on these key factors, we select a particular fund in our portfolio.
wonderful. So the first is consistency of the
Right,
return over a period
right,
of time,
right.
AUM growth and the alpha
Mhm.
positive. And you talked about standard deviation, right? It should
Right,
have a
right,
positive average return, and then the
right.
standard deviation should be less.
Hmm.
Okay, now there are a few questions from our listeners as well. Second question is from Suchet. He's asking,
Mhm.
like, sir, the best performing mutual funds 3 years back are not performing now. Should I
Mhm.
switch funds? If so, then I sell all the units of the old and invest in new, or let the amount be in old and start fresh in new.
So basically, when it comes to funds rebalancing, where firstly we talked about assets rebalancing, this is now
Hmm.
question related to fund rebalancing. Right. So when you have to switch a fund, you whenever you want to take a call to exit a fund, you have to see, as I talked about earlier, when we enter, we see the consistency. Similarly, we
Right.
when we exit, we have to again review that is the fund maintaining consistency or it is not maintaining the consistency. If the consistency is not maintained, I have to see what's the negative that is going to that is currently happening in the particular fund as compared to the its category. लाइक से
Hmm.
क्या फंड ने ऐसे सेक्टर में एलोकेट किया है जो अभी डाउन चल रहा है, इज देयर एनी चांस कि आगे जाके वो फंड जो है वो परफॉर्म करेगा, लाइक वो सेक्टर परफॉर्म कर जाएगा. कई बार क्या होता है कि एक फंड मैनेजर ने उस सेक्टर में एलोकेशन ज्यादा कर लिया, वो सेक्टर नहीं चला, ठीक है,
बिल्कुल.
तो उस वजह से वो फंड नहीं परफॉर्म कर रहा. ठीक है.
Hmm.
बट अब उसको आपको ये देखना है कि वो सेक्टर का थोड़ा सा अगर आप रिसर्च करते हो, थोड़ा टाइम देते हो, तो यू हैव टू सी कि वो सेक्टर के बारे में ऑन बातें क्या हो रही है, एक्सपर्ट्स क्या बोल रहे हैं कि क्या ये सेक्टर रिवाइव करेगा. सो वंस
Hmm.
यू गेट दैट आइडिया, उसके बाद आप डिसीजन लो कि ओके ये सेक्टर ही परफॉर्म नहीं कर रहा, ये सेक्टर आगे कर जाएगा परफॉर्म, देन यू शुड वेट. ठीक है, आपको इन्वेस्टेड रहना है, आपको चेंज नहीं करना. बट अगर आपको लगता है नहीं ये सेक्टर नहीं परफॉर्म कर रहा और आगे भी नहीं कोई उम्मीद लग रही, देन दैट इज द टाइम कि आपको उसमें से एग्जिट करना. दिस इज द वन केस कि सेक्टर वाइज अगर एलोकेशन ज्यादा है, तभी उस केस
Hmm.
में. हाँ, अगर कोई फंड मैनेजमेंट स्ट्रक्चर चेंजेस हुई हैं एक पर्टिकुलर फंड के अंदर या एएमसी के अंदर, इन दैट केस यू कैन इमीडिएटली एग्जिट फ्रॉम दैट फंड.
Okay, so you mean to say is that most urgent reason is that if there's a structural change in the fund or if there's a change in the management, right?
कोई फंडामेंटल एट्रीब्यूट्स, इफ देयर इज अ चेंज इन द फंडामेंटल एट्रीब्यूट्स ऑफ द फंड, और कोई सिलेक्शन प्रोसेस चेंज हुआ है या टीम चेंज हुई है, इन दैट केस देयर इज अंडर परफॉर्मेंस, देन यू कैन इमीडिएटली एग्जिट दैट पर्टिकुलर फंड.
You can immediately exit from that fund. Very good. Next question is from Saharul, and he's asking SIP or lump sum. Sir, which is the best investment? मतलब किस सिचुएशन में हम लोग को सिप करना चाहिए? Now, again, I'm going to add another part of this question is that is it the right time to go for lump sum?
I feel the very first thing that you have to learn as an investor into the equity market is don't try to time it.
Uh-huh.
If you have
Okay.
the surplus, just invest it. Because
Hmm.
I have seen many investor, मैं आपको एग्जांपल दूं तो 2016 में, इफ यू एनी ऑफ यू रिमेंबर, ब्रेक्सिट का इशू आया था. ठीक
Hmm.
है, देयर आर इन्वेस्टर्स हु वांटेड टू इन्वेस्ट, हु हैड रोट द चेक्स, बट स्टिल आज भी चेक अनक्लियर्ड है, बिकॉज मार्केट अभी और गिरेगा इसकी वेट कर रहे थे.
अच्छा.
ठीक है. सिमिलरली ये इस साल भी मैंने जनवरी में देखा है, बहुत इन्वेस्टर्स दे थिंक कि अब मार्केट 51 आ गया है, ग्लोबल वॉर छिड़ गया है तो वर्ल्ड वॉर होगा, ये 40 आ जाएगा. 40 आएगा, हम
बिल्कुल.
तब पैसा डालेंगे, चेक रेडी है बट डालेंगे तब 40 आ जाएगा. आज
Hmm.
मार्केट 60 है, चेक उन भी रेडी, पैसा सेविंग में ही पड़ा है, क्या कर रहा है, कोई कुछ नहीं कर रहा, वो 4% भी नहीं दे रहा उनको, 2.5% भी नहीं दे रहा.
Hmm.
So this is a thing you cannot time them. आपका आपको पता है, you know that I don't need this particular money next 10 years. Just invest into equities, be it lump sum, be it SIP तो mandatory है. If someone is have the capability, understands the equity and don't need the money next 10 years and he is not doing SIP, that should be a non-bailable offense. I personally feel कि अगर कोई बंदा SIP नहीं कर रहा, करने के बावजूद भी, तो उसको नॉन बेलेबल ऑफेंस मान करार देना चाहिए. So this is, I personally, SIP is mandatory. You should definitely have for all your financial goals. इसके अलावा lump sum is the key कि आपके पास surplus है. You donate 10 years, just invest it. Don't see whether the market is 62,000, whether the market is 52,000. At 10 years down the line, again, I said, as I earlier said, Indian markets are going to perform very, very well compared to the global economies as well. तो आपको ये return कहीं और मिलने ही नहीं वाला if you are not investing today.
Okay, great, great. In fact, again, Ajkal, nowadays, another
Mhm.
thing has taken a pick up lots of importance is a passive
Mhm.
fund management style. Active
Mhm.
fund management, passive
Mhm.
fund management,
Mhm.
index
Mhm.
investing. Then we have
Mhm.
got ETFs and everything.
हाँ, हाँ.
Tell our listeners about that also.
Basically, I personally feel I am more a fan of active investing as on date. ऐसा नहीं है कि like say I don't like passive funds, but I
Mhm.
personally feel in India things are going some other way. Like passive की acceptance बहुत लोगों को लग रहा है कि अच्छी है, passive करना चाहिए, but passive वहां करना चाहिए जहां पे अल्फा का potential ना हो. Indian market are not that. Like US में that is a good to go. People are investing into passive funds. One can invest into passive funds there. If you're investing into the international funds, go through the passive route. But if you're
Mhm.
investing into the equity markets, in Indian equity markets, then there is a lot of potential to get the lot of alpha can be generated from the active funds for next 10 years at least. हाँ 10 साल के बाद हो सकता है मेरा व्यू चेंज हो. I am also the one who can be into a, index investing or passive investing, but for next 10 years I am going to 100% into the active funds only.
Okay, okay. See, okay, okay. Matlab, you mean to say that instead of investing in an index fund, which
Mhm.
exactly replicates the index, it's better to go
Mhm.
for a actively managed fund
At least for Indian equities for next 10
for
years.
Indian equities. That makes more
Mhm.
sense, right?
Right, right.
Okay, great. Again, the next question is, are there any other instruments which can beat the market?
Sorry, actually some network disconnection. Can you repeat the
Okay.
question, please?
Are there any other instruments which can beat
Mhm.
the market?
Other instruments among equity or among any other instrument?
He has not specified it. Let's
Uh-huh.
take broadly any other instrument,
I,
equity
I,
and.
I don't feel any other asset class. If you will see last 40 years data from 1982 to 2022, there's a data of gold, silver, fixed deposits, corporate deposits, and the Sensex. So we
Mhm.
can if we see the gold and silver has delivered around 8.5% returns from last 40 years, and fixed deposits have given around 9% returns on an average. Okay, and if corporate deposits have given 1% more than that, but equity markets have delivered around 16% returns. If you talk about Sensex, so I in the past 40 years nobody has beaten the market, and for the next 20 years at least I feel that no other asset class can beat the equity market.
Great. And again, we talked about power of compounding, right? If you want
Mhm,
to grow your wealth, you'll have to use the power of compounding, and one of the
mhm,
instrument to do that is the mutual
mhm.
fund. Now,
Right.
can you tell us how can you use mutual funds to use power of compounding in your favor?
Actually, if you keep on investing for regularly in a disciplined manner, you
Hmm.
now here I'll give you an example to understand the power of compounding better. Now, what mistakes also I have seen the few investors are doing. Say you are doing regularly SIP of say 25,000 rupees per month, okay, and it's
Hmm.
been 4 5 years. You have invested some around like say 15 16 lakh rupees, and your profit is today current value is around 25 to 28 lakh rupees. Okay, this is just a hypothetical example I'm sharing. So if someone has invested 5 years 15 lakh rupees and now today's value 25 26 lakh rupees, so when the markets are going to give you 20% returns, you will be getting the returns on that 25 lakh rupees, not on your invested capital of 15 lakh rupees. This we have to understand. This is what compounding is. Normally what investors do when they see their invested amount 15 and the current value 25 lakhs, they see that there is a 10 lakh profit. I should book the profit first before the profit gets wiped
Just
out
yeah.
in the market, right?
Hmm.
So in that case you are actually you are not actually getting the compounding benefit because you are taking out the profits. How the compounding will work? What is compounding? Compounding is interest on interest or profit on profits, right? Say so if the markets are going to deliver next 20% down returns upwards, you will see the potential gain on 25 lakh rupees of around 5 lakh rupees, not on the 15 lakh invested capital of 3 lakh rupees. So that extra 2 lakh rupees gain is your power of compounding, which you
Correct.
need to continue for next 10 or 20 years, not just for 5 years.
Correct.
So I personally feel normally investors don't have that appetite to let the compounding work. They have read, they have understood the compounding, but when it comes to practically when they see their own portfolio, they don't have the appetite. So you have to understand everyone, the new investors specifically, that compounding is you don't have to see how your portfolio is performing. Always focus on only on your investment part. Obviously, regular rebalancing and monitoring is very important, but just don't look the profits what you are getting out of your portfolio. Only then you can let your compounding work. Always focus on the investment part only. What how much you have contributed in the last 10 years.
Absolutely. Matlab discipline investing over a longer period of time to use the power of compounding in your favor.
Right.
Now, again, next is Sarabjit. Sarabjit ने पूछे है कि what is the difference between online and offline SIP? Now I am new and want to invest in SIP, but not decided, cannot decide which mode should I use.
There is no difference for online or offline SIP. Now, with the emergence of the technology, I feel every SIP is not today in today's date is an online SIP. So there is no such major difference for that. You can go any way you want, you are comfortable with.
Absolutely, absolutely. Now again, Sachet, there is another question. 5 years back, HDFC and ICICI were doing good.
Mhm.
Before 3 years, Kotak and Axis were doing good, and now
Mhm.
only okay, Quanta, PGIM, and Quant are doing good. There
Mhm.
will be no consistency for long term for of 10 years. So how to choose correct fund now so that it compounds even after 10 years?
Okay, so basically, you compound your money for next 10 years, not the schemes you are going to compound for next 10 years. Say if you invested 10 lakh rupees today in a X company fund, okay. So, after 3 years, that fund is not performing, but in 3 years, your 10 lakh has turned into 16 lakh rupees, okay.
Right.
So, what you see that, okay, today some other fund is more consistent, and as per based on your review, you feel that now I have to switch the scheme. I want to rebalance this scheme. My previous scheme is not performing. Again, I would not say that you should not change the scheme based on the last 3 month or 6 month or 1 year performance. You should see the consistency of 1 year, 3 year, 5 year all along. Okay, and if you see that there is a consistency deterioration or underperformance in this particular scheme and you want to switch, then you will switch your 16 lakh rupees, not your 10 lakh rupees. So
Hmm.
your compounding will not break if you change the scheme. Many have this myth that their compounding will break if they change the scheme. So the change is one must do. Obviously, there will be, you cannot bet a particular fund for next 10 or 20 years down the line. If you say, okay, I will invest in this fund for next 20 years. Okay, if the consistency is maintained, then you are good to go. But if there is a change in the consistency and you feel that I need to change this particular fund, you can do so. Your compounding will not break. So there is a myth that you need to clear here.
Absolutely, absolutely. Now, next question is from Jitendra. In fact, he has got two questions, but I'm going to pick the second one. It sounds
Mhm,
more interesting.
mhm.
Now, he's asking, like, should I pay my home loan first or invest in mutual fund, SIP, and equity?
Mm. I feel it depends on your rate of interest you have taken the home loan. So if you have taken the if your rate of interest is around below 9%, then you can continue your mutual fund investments over the period. If your rate of interest is higher than 9%, then you should pay your home loan first.
Okay, great. Now, next is for retirement, retirees, people who have
Mm-hmm.
already retired, they have got
Mm-hmm.
they got some money,
Right.
retirement benefits and everything. So, what
Mm-hmm.
kind of fund do you suggest for those retirees
I
suitable for them?
if there are see two types of retirees. One, they who want to preserve their capital over the period of
Hmm.
time. See,
Hmm.
right? They have some good money which they want to preserve for the coming, like say 10, 20, 30 years down the line. Just for their uncertainties, they don't need a source of income from that money. For them, I would suggest to go for dynamic asset allocation fund, which we discussed earlier. If they understand equity and they don't want to go 100% equity as well. Right.
Correct.
So dynamic asset allocation is the best category to go for them. But if they need a regular income as well. So there are again there is no harm in getting a SWP from dynamic fund as well. So I personally feel dynamic asset allocation funds are good to go for the retirees for next 10, 20 years down the line.
Great, great. And what about debt funds? You spoke about briefly debt funds, different types of
Mhm.
debt funds.
Mhm.
And tell us about debt funds and how to select the correct debt funds and what are the parameters?
So debt funds are like say if someone who want to park the money for less than 5 years, then
Hmm.
they can go for like say 3 to 5 years. If I will say, then someone can select a category of low duration or short duration funds. Now, what the low duration or short duration funds do? Here, the fund manager invests her money into the debentures or security that are maturing that have an average maturity of around 1 to 2 years. Okay. So with the 1 or 2 year maturity on an average, the interest rate fluctuation risk is low, so that's a good to go category for 3 to 5 year period. So if someone has a period less than that, then I would suggest to stay into the ultra short or liquid category only. In the ultra short and in the liquid category, the average maturity is below 90 days, so the interest rate fluctuation risk will be more less. And ultra short duration fund, the average maturity is less than 1 year, so again there is low interest rate fluctuation risk in that. So if someone wants to invest their money for less than 3 years, then go for liquid or ultra short funds. And if you want to invest for 3 or 5 years, then go for low duration and short duration funds.
Correct. What is the average return? What kind of return these funds basically give?
They basically, you can see that average maturity of that particular fund. You will see every fund publishes every month their average maturity or average YTM, yield to maturity. So
Hmm.
if a particular fund is like say having an average maturity of 2 years and the YTM is around 7%, so that is what you can expect in that particular fund. So every fund have a different around in today's date, like since the rate of interest have increased, so one can expect around 6 to 8% yield.
6 to 8% kind of a
Right.
return they can
Right.
expect from it.
Every fund have a different YTM, so that we need to every time we have to check.
Correct. Okay. Now, before get into little bit of more into portfolio and other things, would like
Mm-hmm.
to ask one more questions about
Mm-hmm.
sectorial funds and thematic funds. We
Mm-hmm.
briefly mentioned about thematic funds. What is the
Mm-hmm.
difference between both sectorial funds and the thematic funds?
So sectorial funds basically invest in a particular sector, like say
Yes.
banking sector, IT sector, as we discussed earlier.
Correct.
Thematic funds are based on a particular theme. Like
Mm-hmm.
say if someone wants to invest in a housing development theme, or
Mm.
someone wants to invest in a ESG's companies. So
Mm.
these are the theme based investment. Someone want to invest in particular theme, that is a company is not like say in if I talk about housing development theme, in that the fund manager is not only investing to companies dealing in the home loans. The fund
Mm.
manager is investing into the cement sectors also. The companies are
Right.
investing in also the other construction sectors also. So the all sectors that are related to the housing developments. Okay,
Mm-hmm.
so that is a theme based funds, and sectors are they will stay stick corely into the sectors only. Like say if a bank cement sector fund would be only invest in a cement. However, there is no such currently available sector fund available. But if someone wants to invest in a cement sector only or telecom sector only, then that will invest only in that sector. But if you invest in a housing development as a theme, you will invest in a multiple sector that are involved into the development of the housing in the coming years.
Okay. Okay. Now again, quick questions. A few questions have come from our listeners as well.
Mhm.
From Saravjit.
Okay.
For new investors, which one is better, equity or debt?
For new investors, I personally feel if you are willing to invest for next 5 years, just go for equity. You have to understand
Absolutely.
its risk, and obviously the again the due diligence you have to do, which we discussed in the starting. But obviously, if you have 5 year, 10 year down the line, you don't need the money. Go for equities.
Perfect. And again, next question is again continuing from the compounding side. Okay,
Mm-hmm.
Suchet ne pucha hai. Sir, if I
Mm-hmm.
pause my investment and keep the old invested money
Mm-hmm.
in the same old fund and start a fresh new fund, will the
Mm-hmm.
compounding break?
No, compounding happens on your money, not on funds. आपने
Exactly.
कितना पैसा दिया वो कितना रिटर्न दे रहा है, that will play the role in the compounding. राइट सो लैंड मैटर नहीं करता कौन से एरिया में है. इफ देयर इज अ लैंड इज एन एग्री, अगर मैं एग्जांपल दे रहा हूँ जस्ट यहाँ पे थोड़ा जस्ट टू
बिल्कुल.
रिलेट यू. हाँ, तो अगर आपका इफ यू आर अ फार्मर एंड एग्रीकल्चर लैंड आपकी आपने यू हैव टू बो द सो द सीड्स एंड वहां पे पानी डाल रहे हो, वो बढ़ के पेड़ बन के फल देगा ही देगा. इट डजेंट मैटर आप वो लाइक से नॉर्थ इंडिया में डाल रहे हो, साउथ इंडिया में डाल रहे हो, वेस्ट में डाल रहे हो, ईस्ट में डाल रहे हो, चाहे अमेरिका में डाल रहे हो, हर जगह पे द प्रोसेस इज रिमेन सेम. सो कंपाउंडिंग रिमेन सेम. The main thing is you are investing money and you are investing the right asset class which is at least beating the inflation, and long term it is compounding. So that is more important rather than just switching a scheme or investing like a scheme change करने से आपकी compounding नहीं रुकेगी. So this is you don't need to worry about.
Very good. In fact, we have got one more questions from on compounding from Pawan.
Mhm.
And
Mhm.
power of compounding applicable to all types of fund, or it is only to dividend funds?
It is applicable on equity funds more. However, it is applicable on all type of funds. But if you want to see the real power of compounding, basically, what the power of compounding we talk about is actually the power of equity that we want to highlight here. So, power of compounding happens through the growth of the equity.
Hmm.
Actually the formula works everywhere, but if you want to see the enormous impact or the wealth creation, that can happen through equity funds. Normally I would suggest if you want to go again if you 5 or 10 year down the line, if you have the objective, you can go for flexi caps or mid cap funds or large and mid cap category funds.
Okay, great. And the next question is like riskometer. We often
Mhm,
see like whenever you look at a mutual fund scheme
mhm,
and we see
mhm,
the riskometer. Is it
mhm.
something that we need to take into consideration? That is how to use that riskometer?
This I would definitely basically this SABI has mentioned has asked AMCs to mention the riskometer. There is a significance that we need to look, because normally investor when they are investing into equities, equity mutual fund, what they see the only past performance, like say 1 year returns, 3 year returns, and they feel that if I have invested my money into this fund, I will get this sort of return. But actually that is the past return. So riskometer helps them to understand, oh hello, this is there is a risk component that you have to see. So actually, this is what they are saying. So when you
Mhm.
see that riskometer is very high, you need to understand that okay, my investments are will be at very high risk. So when we mean by very high risk, my investments are going to be into the equities where I can see a downfall of 20-30% in my portfolio as well. So this is what the riskometer highlights. So if you see go into the liquid funds or overnight fund, you will see it will, the riskometer will be on a very low category side. So as I discussed earlier that there is no interest rate fluctuation risk on the overnight and the liquid funds are very minimal. So that's why there is very low risk. But on the equity side, there is a high possibility of capital depre like say capital will fall to 10 or 20% in some cases. So that's why there is a very high risk. So riskometer gives you a single glimpse of the whether the you should invest in this fund based on your risk profile or not.
Okay. Now, next question is from Nimar. He
Mhm.
asked for a multi-bagger stock for a long term. But again, I'll just modify this question.
Mhm.
Uh, Now, if I have to look at from next 5 to 10 years perspective, which are the sectors that you will be looking for? Which are the themes that you think are going to play out in next 5 to 10 years perspective?
I personally feel banking sector, IT sector, and services sectors, basically, and telecom as well. These are going to perform in coming for 5 or 10 years down the line.
Okay, great, great. And next question is from Zitendra. What is the difference between SIP and mutual fund? How mutual fund is different from equity fund? Okay, I think Zitendra, we have already discussed about this question, but again, for his benefit, again, do you want me to read out the question again?
Yeah, please.
What is the basic difference between SIP and mutual fund? So he's confusing between SIP and mutual fund. How
Okay.
mutual fund is different from equity fund? Again,
So
uh,
here I would explain for the knowledge of everyone. So basically, what is a for first we need to understand what is a mutual fund. Mutual fund basically is a pool of investment where you, me, and everyone crores of investors are investing their money, right? So then what the that pool of money is being taken care by the AMC, which we call asset management company. Okay, so
mhm,
there are around 43 AMCs in India as on date, SB like SBI mutual fund, SDFC mutual fund, and so on. And what these mutual fund companies do, they hire an expert which we call a fund manager, what who further invest their pool of investment into different type of securities that we discussed earlier. One is equity where the investments are going goes into stock markets where the fund manager invests in the shares of the companies and he takes the equal ownership of the company. So which means how the way the companies we are going to perform in next 5 or 10 years, similar will be the returns of our portfolio. And the other security is debt, which we discussed earlier, where the fund manager lends our money to government, to companies, to RBI, and to other issuers, and earn a fixed rate of interest from them. And after the certain period of time, he gets the maturity back or principal back. So in that, these are the two asset classes where the fund manager invests. Now, as an investor, we have two choices: whether we want to invest into equity or debt. If we are willing to take the ownership risk, where we see that okay, I want to profit from the growth that is going to come in the companies in next 5 or 10 years, then you should invest into equity. And if you see no, I don't want to take that growth, I don't want to risk my capital, I want to just earn a minimum rate of interest, then you can go into the debt mutual fund or debt securities. So obviously the fund manager who is investing into equities, he's managing a equity fund. And the fund manager who's investing into debts, then he's managing a debt fund. So
mhm.
now again you have a choice that you want to invest whether one time or whether on a monthly basis. So if you invest a one time, that is what we call a lump sum. And now when we invest a monthly, that is what we call a systematic investment plan. So there is technically, if you'll understand from this, that there is a no difference between SIP and MF. SIP is a method to invest in a mutual fund. All right. And equity fund, as I already discussed earlier, I have tried to explain.
Fantastic. Fantastic. I think you have explained it very, very nicely. Anybody who is absolutely new to mutual fund investing,
Mhm.
I think he's now absolutely clear on all the concepts, right? Now, again, Gurpreet, it's a wonderful session that you have really done and lots of questions being asked, and you have cleared lot many questions. Again,
Mhm.
before we close the session, what is the
Mhm.
final message to all the listeners? Um, can you sum up the whole learning of today's session?
Definitely. If you're new or if you're already investing into equity, into the mutual funds, I would suggest, like say for next 10 years, if you have any sort of money that you need next, don't need till 2032. Just simply do SIP in equity mutual funds. And whenever you have the surplus and you see there's a correction in the market, just invest in the market. Don't time the market. बिना देखे मार्केट में बस पैसा डाल दो, अगर 10 साल नहीं चाहिए, 62 पे है तो भी डाल दो। अगर मेरे पास आज कोई मुझे 10 लाख मेरे पास आ जाए, मैं आज 10 लाख रुपए उठा के डाल दूं, मैं नहीं देखूंगा मार्केट कल 62 हजार है, 63 हजार है, 52 हजार है। आई विल नॉट सी द मार्केट, आई विल जस्ट सिंपली इन्वेस्ट इन टू द मार्केट, बिकॉज आई डोंट नीड द मनी इन नेक्स्ट 10 years. So if you have this objective, just stay invested. India is going to give you the fantabulous returns no other asset class will give you. So you don't need to look here and there. Just keep on in doing SIP and invest lump sum whenever you have that.
Absolutely fantastic, Gurpreet. Really appreciate your time. Thank you so much, Gurpreet, and all our listeners for being a part of this program. And we keep on doing it every Wednesday. Please do join in our, mutual fund pe charsa. Gurpreet will be there. Other speakers will be there. So with that, I would like to close the session. Thank you, Gurpreet, and thank you
Thank
to
you.
all our listeners.
Thank you.